Hey everybody, the class I'm teaching all over the place this month, online and in person at the libraries and community colleges, is all the different safe investing options out there. And because I'm doing annuities in another 2 months, I'm going to do a whole series on the safe investments out there on annuities. And I have my safe investment update in the bonus videos out there. So you'll get treasuries and things like that. But I noticed I hadn't really talked about bonds in a while. So I wanted to talk about what bonds are. What are bonds? We have to remember that bonds are really just you lending somebody money, okay? You're lending a company money, you're lending a government money, you're lending money to somebody, and they're paying you interest, and at the end of the term, they're going to pay you back money. That's what they do. That's what a bond is. So in my example here, I have a 6% interest, which is called a coupon in the bond world. Okay, 6% coupon, $25,000 issue. They call this the par price. The par price is how much they're going to return upon maturity, and a 30-year maturity. How many of you would buy a 30-year CD? Because it's the same thing. Think about that. A CD, it pays you interest, and at the end of the term, they hand you back your money. Isn't that exactly what a bond is? They hand you interest until the end of the term, and then they hand you back money. That's what it is. That's what a bond is. But most of these 20, 30-year bonds, there's even 100-year bonds out there, by the way, which I don't know that I would ever want to do that. But understand the difference in the bond market is there's a somewhat efficient marketplace to buy and sell used bonds. They don't have that really with the CD world. There's a little bit of that going on, but it's not as efficient as the bond trading world, okay? So the big difference is with bonds, you're lending somebody money, they're paying you interest, but if you want your money back, you can just sell that to somebody else and they'll pay you for that, right? So that would be the big difference between CDs and bonds. Now, taxes, understand when it comes to taxation, the interest that you're being paid is taxed as ordinary income unless it is a municipal bond. If it's a municipal bond from the state that you're in, it's double tax exempt. The interest they're paying you is not taxable in the state nor federally. If it's from another state, then you won't pay taxes federally, but you may have to pay taxes in the state that you're in, okay? So that's important to understand that side of it as well. Now, what's the problem with bonds? Well, we got to understand that teeter-totter. Okay, as interest rates rise, the value of bonds goes down, and that's what most people have experienced this year. And honestly, if you're retired, if this is your only safe investing choice, you had a terrible year last year. And honestly, bonds haven't done anything for you since after 9/11 when Alan Greenspan dropped interest rates very low, right? We haven't had much of a return. You might think you have, but the actual numbers show you have not had much of a return at all in bonds since 9/11. That's 20 years, by the way. 20 years bonds have been terrible. Okay, and here's why. If you bought a bond at 6%, okay, that's the par value. They're guaranteeing you 6% for 30 years, and then at end of 30 years, you get your money back. But 5 years later, you want to sell this bond, okay? Now, let's say interest rates are lower. Interest rates are 4% when you go to sell this, and everybody's eyes get really big. Wait, you have a 6% bond? Are you sure you want to sell it? I'll buy it. I want it. And then 50 other people stand there and say, I want it. I'll pay you more. And so what you'll see here is that you'll get 30 grand. That's just, using it as an example. You paid 25, interest rates went down, the value of that bond went up, and now people will pay you more for that bond. You get a profit, and that's a capital gain, which will be taxed regardless of the municipal bond status or corporate bond status. Capital gains are going to be taxed. Okay, that sounds good. Wait a second, I'm going to get paid interest and then I'm going to get a nice bonus when I want to sell it. Well, that's what bonds have been doing for 40 years. 1982 was the peak of interest rates. They've been coming down ever since then. After 9/11, there's been a little bit of floundering. It goes a little up and a little down, little up, little down. And when we hit zero after the pandemic, boy, there's no reason to be in bonds because we are not going to see lower interest rates, right? They're flounder sideways is what they're probably going to do. But if they go and raise interest rates like they have for the last year, look what happens. Now, all of a sudden, we can get an 8% bond and nobody wants to buy your 6% bond. Nobody wants it. So that's why as interest rates rise, the value of your bonds go down. And when interest rates hit zero, the logical choice is to get rid of all your bonds. And if your advisor didn't and doesn't have a plan to get rid of bonds, somebody's asleep at the wheel and not paying attention, right? When interest rates hit zero, that's the highest value your bond will ever be worth. You get rid of them because the only direction they're going to head from there is interest rates rising. If we go negative in interest rates, you'd be crazy to own bonds for quite a while until we go back to the 10, 12% interest rates. Okay. Risk. Well, maturity, who wants to sit around and wait for something to mature 30 years? Right? So we can sit around and wait for 30 years and get our money back. If interest rates keep rising and rising, we don't need the money. We can sit back and wait 30 years and get that full value back. That's fine. That somewhat protects us if interest rates rise, and we can sell it if interest rates fall for a profit. The call feature we do need to know about. There are periods of time in that bond contract that I'm sure you never read, and most likely your advisor never read, but there are time periods where they're allowed to call them due. So imagine you were the person that paid $30,000 for that 6% bond because interest rates were 4%. So I paid $30,000 for a $25,000 bond, and they call it due, and they hand me $25,000. I just lost $5,000 because I wasn't paying attention that there was a call date coming up. We don't want those things to happen. That's a risk, right? Default. What if they can't pay me back? What if the company goes bankrupt? Well, they sell off all the assets, pay the lawyers most of the money, and give you 20 cents on the dollar. Interest rates rising is a risk. Credit downgrading is a risk, which happens more and more the higher interest rates are because it strains the companies that have lots of debt. So you might be an A company, but because interest rates keep rising, the burden of the higher interest rates on the company's balance sheet might get them pushed down to a triple B, and now the value of that bond will drop as well. The worst is when those triple Bs fall into junk status, which I will show you right here. The ratings companies that are out there, typically it's Standard & Poor's and Moody's when it comes to the bonds, okay? They really are the ones that we have to look at, because siphoning through every single individual bond issue and putting a rating on it is not something any advisor is capable of doing, to be real honest. And I don't know that I would trust him because he's trying to sell it to you, okay? So we have these independent third parties putting a rating on these things, and the regulators have used this. The regulators call anything AAA, AA, single A, and triple B considered investment grade, okay? Anything below that is considered junk, which has been rebranded as high yield in your bond funds, because the only people that can buy those junk bonds are mutual funds, and they call them high yield because it sounds better and it's easier to sell you that, okay? Regulators say that all the banks, all the pension funds, insurance companies, all the big public funds of money can't touch these junk bonds. There's too much risk in them. They're not likely to pay back all the money. So why would you throw your money in these things, right? Well, that's why the junk bond status, and that's why most people can't invest it, and that's why they throw it all in mutual funds to die. And who buys the mutual funds? Oh, high yield sounds good, doesn't it? Got to be careful about these ratings and how these things work, because that's how you'll lose value on this. So when we talk about safe investments, we just talked a lot about risks there in something that has been the primary go-to safe investment in everybody's portfolio. Kind of makes you start scratching your head going, why? Doesn't really make any sense. Well, remember, interest rates were at 12, 13, 14, 15%, and they've been steadily coming down and down and down. So you were getting paid interest, and you were making a profit because it was worth more every year that interest rates came down. So for the last 40 years, they kind of did look pretty good. They've somewhat floundered for the last 20 years because when 9/11 happened, we dropped interest rates down pretty darn low. And then we pushed them a little bit. In 2008 happened, and we dropped them again, and we pushed them a little bit. And then 2018, believe it or not, there was a little mini crash at the end, and it was fast and furious right at the end of the year. And they dropped the interest rates back down again. And then we hit the pandemic, and they dropped them down again. So we push them up to have room to drop them down. That's why we do it. The other reason we do it is inflation. And who wants to be in a bond when we see inflation? When we see inflation, they raise interest rates, and we lose money in our bonds. Why are we in bonds? It doesn't make sense. Municipal bonds, just understand these are the same structure as corporate bonds. There's not really any fundamental difference other than the interest, maybe tax exempt federally and possibly state, okay? But there are two different types of municipal bonds. There's general obligation bonds and revenue bonds, okay? General obligation bonds are backed by taxation. That's where you typically find little to no risk, okay? Revenue bonds is where you find the risk. This can be anything from a municipal airport project or a long-term care facility or even a shopping mall, okay? We got to be careful about this. This is a developer in the pocket of a politician that says, hey, yeah, sure, go borrow the money all you want, and it's municipal bond status. You get all these wonderful perks and tax benefits. It's fantastic. Go build whatever you want and then sell it off and make your profit. And everybody's happy. And we do it on the municipal bond status. It's wonderful for everybody, right? And so that your community gets upgraded. And that's the essence of it. It's, you know, not all dirty behind the scenes, but the reality is if somebody wants a shopping mall in their town, then they put municipal bond status on it. And City North on Tatum and the 101 here went into default twice and really hurt the municipal bond investors in that project. So I had my offices there. So I watched it happen. So you got to be careful a little bit with these revenue bonds. Also understand behind the scenes what's going on is there's something called market makers. How do you price these bonds? Who's really in charge of the pricing of these bonds? Well, if I'm a big company, and I'm not going to name names, but they all do it, they're going to go buy blocks of bonds. They're going to find bonds, and because they're buying them all up in big blocks, they get better pricing, right? And then they're going to turn around to all their clientele and they're going to say, oh, I'm going to sell you some of these bonds and I'm going to sell you some of these bonds. And, oh, you don't want your bonds anymore? I'll buy them back from you. And then I'm going to sell them to you over here. And that's what they do. They internally run through all their bonds and churn and buy and sell and buy and sell. So guess who's setting the price? Well, it's the owner of the bond, which happens to be the investment company who is managing your portfolio. And that's the dirty side. And that's why we still have bonds in everybody's portfolios, because every one of these big entities out there, every single one of them is doing it. And that's how they're making tons of money behind the scenes, because they're going to buy it from one client for 100 cents on the dollar and turn around and sell it to another client for 110 cents on the dollar. That's what's going on. Nobody wants me to tell you that. If I'm not back next week, you know something happened to me. So here, you look at these individual bond portfolios, and look, this was a 2018 portfolio that actually walked in my office, and I asked her if I could use this. It's anonymous and all that, but it's such a learning example here. She was happy with the portfolio. She wanted me to review it, and she said her advisor, put a very safe portfolio together for her. She had a 4.5% coupon. If you look down on the bottom there, average coupon from 3 up to 6 in this portfolio. She averaged it out. She's making about 4.5%. And when interest rates were virtually zero in 2018, that seemed pretty good, right? But the problem was I had to be the bearer of bad news. I showed her that she paid $593,000 for this portfolio. You see the cost basis column? And all these maturities were coming up real soon. So they were all short-term bonds. I think 5, 6 years was, 7 years was the longest one. So very short term. So it was obvious that we were waiting till maturity to hold these through maturity. That was the goal of this. So I looked at all those cost basis and I said, well, you understand each one of these is a $25,000 bond. When it matures, which it's obvious you're going to hold it to maturity because some of these were 6 months before maturity, you get back $25,000. So if you paid $28,000 for this bond and you only get back $25,000, what are we getting out of this? And so we have to learn a lesson from this. The coupon means nothing. A 3% coupon is not worse or better than a 6% coupon. You have to calculate the yield to maturity. Yield to maturity is all that matters. It takes into account that you paid $27,000 for something that's going to hand you back $25,000. You lost $2,000 there. So how much interest are you going to make? Well, if you're going to make $5,000 in interest, then you're really only going to profit $3,000, and the yield to maturity is what tells you that, right? It's really obvious here. Look at the first one. We underpaid. We paid $24,000 for a $25,000 bond, so the yield to maturity is higher than the coupon. But all the other ones we overpaid for, and the yield to maturity is lower than the coupon. And one of them is negative. I've only seen that once, right there. And that's why I held on to this, and I like using it as my example. I thought that's illegal, but who's really going to sue this kid and get his license pulled? Nobody. This advisor bought an investment that has a guaranteed 2.98% loss. That makes no sense. I don't understand a world where any advisor should be allowed to do something like that. That's ridiculous. Sure, he made a great commission on it, but that's wrong. That's absolutely wrong. So when it's all said and done, the 4.52% that she thought she was getting, that her advisor so wonderfully pointed out that she was making 4.5%, actually has a profitability of only 1.92%, and that advisor had a 1% management fee. So unfortunately, we have to be careful with these individual bonds, right? Yield to maturity is the only thing that matters. You should be asking anybody that's in charge of investing your portfolio, what's the yield to maturity if they're buying individual bonds? And you want to know that number before they buy it, right? Now, are individual bonds better than bond funds? Well, I got news for you. When we're going through things like we are right now, individual bonds are typically better. And here's the reason. As interest rates rise, the value of your bond goes down. But you can wait till maturity to get your money back or get the par value back. So if you're careful when you're purchasing, if you bought a $25,000 bond for $25,000, then you can wait till maturity and get your $25,000 back, okay? So that's the big plus on individual bonds. As interest rates rise, the value of the bond goes down, but if you don't have to sell it, who cares what the value is? You're going to wait till maturity and get your money back, okay? But we do have a marketplace, so if you need the money before maturity, then you're going to have to find somebody to buy it, and now you're at the mercy of those interest rates. Bond funds, on the other hand, are very efficient of lowering and raising the value of that fund because it's one price that represents the value of that mutual fund. And if interest rates rise, the value of all those investments in that mutual fund just went down, and so the price goes down. There's no maturity dates for you to fall back on. So if interest rates keep marching higher, that bond fund's never going back to the price it was. That's not how this works. This is not a stock mutual fund. That's not a stock ETF. It's a bond ETF. It's a bond mutual fund. You're not going to sit here and wait for that. Okay. Funds are replaced with higher yielding, funds. So here's the thing. We've spent 20 years at almost no interest rates, very, very low interest rates. If you really look back at interest rates, you wouldn't believe it. It's been 20 years since 9/11 happened, when the big fall of interest rates really jumped in, okay? And then we never pushed until 2006, 7, and then we tried to push and it fell everything apart in 2008, okay? So here's the thing. Bond mutual funds, bond ETFs, bond portfolios were filled with good interest rates leading into the 2000s, and all of them matured, and they had to replace them with little to no interest rates. And the regulators after 2008 forced them to buy treasuries on top of that. And treasuries were paying nothing at that time too. So those bond mutual funds can't keep up with interest rates, because it's not like they can just go sell the whole portfolio, because they're filled with a whole bunch of very low interest rate bonds right now. And if they sold the portfolio, they'd get pennies on the dollar, and it all looks terrible. So how are they going to do this? Well, as things mature, hopefully they'll be able to add some higher return stuff. The other thing they did was fill it with junk bonds that pay higher returns. Be careful about your risk in these bond funds. Okay, mutual funds don't settle till the end of the day. You can hit sell and it's like, what's happening? It's not selling. It's not selling. Mutual funds, you hit sell, whatever the price is at the end of the day is what they've sold it for. ETFs sell more like stocks. It's instant. You hit sell, it sells. There's the yields that you're getting out there. Hopefully we see all these. You know, the safe corporate bonds, 4 or 5% is what you're getting out there, right? But we have risk. Even if it's a AAA, you have risk because of interest rates. Interest rates rise, the value of your bond goes down. You go buy one of those bonds right now, and the Feds raise interest rates a couple more times this year. Next year, it's not going to be worth as much. And you're going to lose money in your safe portfolio. Okay? So we can get 5 with no risk. Remember, we've got plenty of choices out there. We can get 5 with no risk. I'm not sure why we'd take 5 with risk. And why would I want to lock into a 20, 30-year bond for 5% when I can get, honestly, I could go to the Treasury and get 4.5% for 6 weeks. I don't know why I'd want to lock in 5. If we get back to 10, 12% interest rates, I'm going to look for every 30-year, 100-year bond I can find. I don't have a problem with it once we get up there, but we're at 5%. And historically, that's not that great. All right. So here's what your bond funds, if you don't believe me that bonds haven't done well for 20 years, well, look at it. Your first line up here, portfolio return. This is the largest bond fund in the world, BND, okay? This is your first line portfolio return. That's the total return. That includes the yield you have received. The 1 month is negative. The 3 months, great, 1.64. But 6 month, boom, 3% down. 1 year, 13% down. 3 year, 2% down. 5 year, flat 0. You've made nothing in this entire time you've been in there for 5 years. 10 year, you've only had a 1% return. 10. 20 years, you've only had a 2.95% return. What the second line is the calculation of inflation. The third line is your adjusted inflation numbers. And honestly, being in bond funds has done nothing for you. As crazy as it sounds, I would have rather seen you in a CD than these bonds. These bond funds have done nothing for you. And if we hold these interest rates higher and push higher, this is going to get worse and worse and worse. And the market doesn't really care what you used to have. It's not going to come back until we plummet interest rates right back down. And then hopefully you have learned your lesson. If you're not going to sell now, you should be selling when interest rates plummet next time, okay? Because look at this chart of interest rates. It's not like we've come up very much. And the returns that you've had in your bond funds for 5, 10, 20, 30 years have been terrible. And look at this chart consistently going down, down, down. And only for the last year have we come up just a little bit. That should put things into perspective, why those bond funds really have done nothing for you. All right, hopefully that puts bonds into perspective. It takes consistent interest rates going down, 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 down for you to make money in those bonds, because we're not at high enough interest rates for this to make sense, and we have better alternatives out there. So hold off buying your bonds, reconsider the bonds that you have in your portfolio, look for better alternatives, go to my videos on all the different safe investments out there. Bonds, you are lending entities money, and they're happy to take it from you because you're not really getting anything out of this, and they are. Okay? Be careful about this. Let us know if we can help out in any way. Always happy to scour through portfolios and give my opinion on them. And certainly I can help out finding the right safe investments for you. Give us a call anytime. Live via Zoom nationwide. Always happy to meet with people. I've been meeting people all over the United States, and believe it or not, in some other countries. We've got clients living in other countries as well now too. Even though they're U.S. citizens, they're trying to invest their money that they have in the United States, and it's a fun little adventure hearing where they're living and what they're doing. I have a client with a negative interest rate on their $1 million+ mortgage. Think about that one. Take out $1 million mortgage and you're obligated to pay less than what you actually borrowed. Cool concept. So let us know if we can help out. Give us a call, shoot us an email, share these videos with people. And I'm coming back every week with 2, 3, 4 more videos every single week. So keep coming back, keep watching the videos. If you haven't subscribed, please do, and share it with your friends. See you next week.